The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Economic resiliency being put to the test, and so too is the stamina of financial markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. You take a look at the S&P 500 right now, building a slight rally underway. The S&P 500, that big benchmark, up about 0.2%. We're still below 6,000, but we're pretty close to an intraday bull market, up 20% from the lows. We'll see if we can finish there. You take a look at the Russell 2000. This was your leader yesterday. That position being given up a little bit today. The Russell 2000 off by about 0.1%. And the bond market, Romaine, here is where a lot of the action is. You take a look at 10-year Treasury yields right now, down about 9 basis points. More in just a minute, but quite a rally there.
Absolutely. And as far as that intraday bull market, we are within reach of that, but the economic data not necessarily cooperating. That ADP jobs report, 8:15 a.m. Wall Street time, a sobering prelude to Friday's official government report. ADP saying private sector payrolls increased just 37,000 last month, the slowest in 2 years and lower than all estimates in a Bloomberg survey. Now, take note, ADP is just a supplementary view of labor market conditions, and that doesn't necessarily predict what we're going to find out on Friday with the government's monthly unemployment figures. But still, things got even more messy at 10 a.m. with the Institute for Supply Management saying its index of services, that fell into contraction territory, dragged down by retail, construction, and warehousing. Order backlogs, they shrank, and prices paid, they jumped to the highest since November of 2022. Now, remember, the services industry accounts for the lion's share of GDP, so as it goes, so goes the economy. One bright spot, though, could be found in hotel and food services, so some resiliency there. But as Kendrick would say, maybe it's just not enough. Traders of swaps contracts that predict Fed rate changes now pricing in higher odds of lower rates, 2 quarter-point cuts by year-end in October and December. And Katie, the possibility of a move in September, that bumped up to 95% from 82.
Well, you look at how that is playing out in the bond market. I have yields of the different maturities up here from short to long. And as you can see, over the past 2 weeks or so, yields have been coming down. Let's focus in on this blue line. That is your 10-year Treasury yield. Right now, we are below 440, trading at 4.36%. We were as high as 4.6% just about 2 weeks ago. Of course, you can see if you zoom in that move just today, that coming on the heels of that data that you talked about, Romaine, really setting the scene for Friday's non-farm payrolls report. It feels like the 10-year yield can't get too far away from 4.5%. That has been the story of the past few months, but could be starting to see a little bit of a different message.
Absolutely. We're going to get back to that in a second, but let's take a little bit of a walk back in history, back to 2018. That was when the Fed hit Wells Fargo with an unprecedented penalty for years of misconduct, an asset cap that basically prevented it from growing. Within a year, the CEO was out. A new CEO was in, Charlie Scharf, taking the helm, tasked with really cleaning up the bank's marketing practices, reining in a lot of those costs, and, of course, mending ties with Washington. And one of the first big hires he made was as CFO, Michael Santomassimo. And now 7 years after that asset cap was put in place, it's now been removed. The Fed satisfied that the bank has indeed shored up risk management and board effectiveness. Pleased to say that Mike Santomassimo joins us right now from the floor over there at Wells Fargo. All right, Mike, we've had you on this program a lot, particularly around earnings season. I think every quarter we ask you about the Fed constraints, that asset cap. Every quarter you've elegantly dodged my questions. Now that cap is gone, and of course investors, they want to know what's next.
Yeah, well, first, thanks for having me. And, you know, look, the result of the asset cap going away is really the culmination of like years worth of work for thousands of people across the company. And so we're proud of that work. We're thankful for all the effort that was put in there. And when you look at, you know, all of what we went through to get it validated and reviewed, I think, you know, we're very happy that sort of we got to today. And as you sort of look forward, you know, I think it's a lot of the priorities that we've been talking about now for the last, number of years in terms of all the investments we've been making across the consumer and the wholesale businesses. And that's really what's going to drive growth over a long period of time.
Is there a sense now, I mean, with these constraints removed, and I know this has been a long evolution, so no one's expecting sort of a switch to flip and you're just going to be a totally different bank. But I am curious about what is needed, particularly from your end as CFO, to sort of chart a course of growth rather than just kind of making things better as they are.
Well, that course was charted years ago, right? And while we were fixing all of the risk and control work and building out that infrastructure, that was always the top priority. But along with that, there was we set out 5 years ago to really start to take a lot of the efficiency savings that we were generating and reinvest those back into the businesses. You can look at our credit card business as an example where we've replatformed, all of the products and have launched 11 new products since 2019. We've been investing in our branch system by refurbishing those branches, investing in the people in there, changing what they do, and providing more advice across the investment side of the business. We've been investing in our wealth management business more broadly to continue to improve the productivity and the capabilities they have. And then on the commercial side, it's adding hundreds of commercial bankers across the country. It's adding senior investment bankers across a number of different areas in the investment bank. And then within the markets business, it's continuing to just methodically invest in technology and people to see growth over a very long period of time. This is not something, as you say, that's like all of a sudden, you start to see the growth like this morning. This is something that'll be over the next 5, 10, 15 years where we'll see, good sustainable growth across all of those businesses as we make the investments.
Well, Mike, let's talk about what's still left to do, because my understanding of the situation is that, okay, the Fed lifted the asset cap that had been in place since 2018, but the rest of the consent order remains in place. So what work is still left to do? And do you have a timeline for when we might see the rest of the consent order lifted as well?
Yeah, no, sure. It's a good question. And, as you look at, where we are, we've completed phase one, and that's what you see when the asset cap's released. And what that is really adopting and implementing all of the changes that we need to do. And phase two is just seeing those sustain themselves for a longer period of time, and that'll get revalidated as we go. No time frame. That's really up to the Fed ultimately. I'm sure that's a familiar answer, Romaine. Sorry, yeah. But ultimately, we'll see that through, like we have all of the other consent orders that have gone away over the last number of years.
And one of the things that you mentioned that the bank has been doing has been refurbishing branches, for example. And when it comes to the actual customers of Wells Fargo, 2018, it feels like a lifetime ago, but in actuality, it wasn't all that long ago. Do you think that you truly have won the trust back of those customers, or is there still more work to do there as well?
Well, it's certainly something you do every day as you serve customers. And I think when you look through and see, the engagement that we had throughout the years, the engagement was still quite good across many of the businesses with our customers. What you didn't see happening, though, over those years was growth, for all the reasons that we've talked about over time. But look, you're always working to ensure you're providing the right experience, the right products, the right capabilities with customers, and that just builds and builds over time by execution. And so that's something you try to never lose sight of.
Hey, Mike, I do want to get your thoughts, since we have you here, just on kind of the broader economic conditions, kind of the state of consumer spending. And I know we got some flavor out of that on your last earnings report and earnings call here. But given all that's transpired and given all the volatility, of course, it seems to be associated with Washington policy and, of course, economic conditions, are you still confident in the forecast that you've gotten, and are you confident here in the consumer business, particularly when it comes to making sure that the folks that you've lent to are going to be able to pay their bills?
Yeah, no, there's certainly a lot to look through when you think about headlines or a lot of what's been reported. But when you do that, the trends have been actually quite consistent. Now for the last couple quarters, where we see the consumer still very much actively spending and out in the supporting the overall economy. Those categories, and I think you talked a little bit about this in your intro, the categories move around a lot. They could be spending on travel in one month and other categories in other months, and so but in aggregate you're still seeing some growth year on year, and that spend that people are having both on the debit side and the credit side. And so they've been very, very, very consistent now for a while, and you still don't see any real signs of real systematic stress coming through in the credit side. You certainly see that lower end consumer in terms of lower wage earner being more stressed than others, but that's been pretty consistent now for a while, and you're not seeing things deteriorate in any significant way at this point. So I'd say so far probably better than people would have expected coming into the beginning of April or post the announcements in the beginning of April. But so far I think it's been a pretty consistent trend, and so hopefully that continues and should continue to support the broader economy.
Have you had to or had any meaningful discussions about tightening your own internal lending standards?
No, not meaningful, not substantial. You're always in any environment thinking about, risks that might, come through all your portfolios. But anything we've looked at is sort of really on the margin, nothing substantial in terms of that at this point. And then certainly same thing on the commercial side, very consistent in terms of the overall underwriting that we have. But you certainly think about, different scenarios as you look forward in case things turn out to be a little bit worse than you might expect. But so far, we're just not seeing that come through in the data.
And Mike, I want to get your thoughts on the state of the deposits business, because it feels like for the past several years in this higher rate environment that banks such as yourself have been competing with money market funds for deposits. You can still get about 4% for a money market fund. And Romaine was just talking about what's priced in terms of rate cuts this year's, just about 2 quarter-point cuts here. So how is that going, that deposit side of the business? And are you seeing growth there?
Yeah, look, it's been pretty stable now for a number of quarters, and we did see a little bit of growth in the first quarter, as we reported, and a lot of that migration into money market funds has somewhat stabilized now over the last probably year plus. You still see a lot of money in money market funds for sure. But you're not seeing, the same level of migration into, either higher yielding deposit products or money market funds as we saw, call it 18 months ago or 2 years ago. That trend certainly has stabilized. And what will grow deposits over a long period of time are really two things. One, just growth in the economy, right? So if the economy continues to grow, there's, deposits in the banking system should follow it. And then two, as we continue to do and execute on our priorities and see growth in the underlying businesses, that should support deposit growth as well. And those are the things you'll start to see, I think, hopefully, as we go through over the coming quarters. But we're not seeing any sort of big changes in the behavior or trends than what we've seen in the last couple of quarters.
What does competition look like for you right now, Mike? I mean, particularly when we start talking about deposits and just, I guess, what we would consider traditional banking, and you look at all of the new players, the new entrants into this space, the fintechs, if you will, for lack of a better phrase here. Do you see those folks as formidable competition?
Well, look, it's a competitive space for sure, right? I mean, I think, you look across the banks or just the broader, financial services spectrum, we operate in a competitive environment. And so that's why it comes back to, having really good capabilities. I think the advantages of having, one of the largest, branch networks across the country, all of the digital capabilities that we can provide, the broader set of lending that we can give consumers, the investment management advice that we can provide that sort of, complements that relationship. Those are the things that I think are really hard to compete against if you're a fintech or other, provider that's got a pretty narrow solution. And so I think our the fullness of our capabilities allows us to compete very well in this environment, but it is competitive, and that'll likely be the case, which is not a bad thing, necessarily for consumers, and sort of makes you make sure your capabilities are where they should be.
All right, Mike, we know it's a busy day on your end. We really appreciate you taking the time. That is Mike Santomassimo. He is the CFO of Wells Fargo.
Just gave him a promotion.
Gave him a promotion. What a big day over at Wells Fargo. Let's get back to these equity markets right now, because global equities hitting a record high for the first time since February. Signs of a resilient U.S. economy seem to be overshadowing the themes of uncertainty surrounding global trade negotiations, a move that Wall Street's, quote, smart money didn't seem to anticipate, but retail traders did. Here to break down where the money is moving is Steve Quirk. He is Chief Brokerage Officer over at Robinhood Markets. Great to have you with us. And what an interesting perch that you have when it comes to viewing what individual investors are actually doing with their money. So if you take a look at the activity on Robinhood's platform, what trends have stuck out to you?
Well, I think a trend that actually kind of emerged during COVID has sort of resurfaced, and that is, the retail customer is sort of stepping in and buying on the dip. And, there was a lot written about that period, that there was a lot of institutional selling in all the names, the hotels, the airlines, everything that was suffering as a result of COVID. And retail customers stepped in, and they were rewarded pretty handsomely for doing so. This was kind of a repeat, because we had two of our, the way that we can look at that is we look at the amount of deposits that we get and then the activity. The first 2 months were the biggest deposit months we've ever had in the history of Robinhood. And then we looked at our equity activity, our option activity, even some of the crypto activity. And they were definitely stepping in and purchasing.
Yeah.
But we had some, you think about it, you had some of the most popular names down close to 50%. And so customers are like, look, these customers are in their early 30s. They have a 30-year investing duration. So they're quite savvy. They realize, hey, I might not get this perfect, but I have quite a while for these stocks to recover.
Right.
And these are great names.
If you have a strong enough stomach and a long enough investing timeline, I see your point that a lot of these names have been on sale, but compare and contrast to the COVID period. You mentioned that airlines, for example, that was a popular buy the dip trade back then. I have to imagine this time around we're talking about the NVIDIAs, the Teslas that are out there.
Yeah, the compare and contrast is like the tariffs were impacting a completely different set of names. And these, by the way, these were some of the hottest names because they do a lot of business internationally or are reliant on supply chains and things of that nature. And our customers are also well aware that this isn't over yet. So, I mean, as much as they have benefited from stepping in, you see them start to rotate out of some of these where they've seen 40% appreciation in a month. I mean, who wouldn't take that, right? They kind of act as portfolio managers within their own portfolio, which is amazing. I love it. I mean, from a retail customer standpoint, it's great to see investors do that.
I am curious, though, about the evolution of this. And I think it's interesting that you put it that way because you do see a lot of elements of that. When you talk about how, and to your credit, how Robinhood has actually moved the needle forward on the evolution of financial markets, there's also been a lot of talk about having more consistent trading, basically round the clock. Obviously, we are on 9:30 to 4 p.m. It's the tradition. I understand that. There is after-hours trading, but is there going to be a real, true 24-hour ecosystem that is going to be liquid and reliable?
Yeah, we started this in 23, and we have 1,000 symbols that trade around the clock. But if you think of the number of asset classes that already trade around the clock, it's something that, if I came into the marketplace as somebody who was intrigued by crypto, that's what I'm accustomed to. I don't understand a market where, some person who looks like me has to ding a bell twice a day for anything to happen. And our customers do about 70% of their research or their homework and work on their investment theses when the market's closed. So it's very foreign to them that they have to wait until the next morning to put, if I want to buy stock ABC at $10, I don't care if I buy it at 3 a.m., I don't care if I buy it at 2 p.m. And with the market moving news that's happening around the clock today, I mean, our biggest days in the overnight sessions are all this tariff news is happening on a Sunday evening, on a Friday. I mean, it's not happening during regular market hours.
I'm really fascinated by this, and I think it was a few weeks ago we had the head of your prediction markets on the program.
JB McKenzie.
And, wonderful guy. And I am curious about just this idea also, and we talk about the evolution of financial markets, of prediction markets. And I know, you bristle at the idea of calling it betting, but we've seen it applied in very legitimate and in some cases reliable ways. And I am curious as to pending regulatory approvals, how much further you can push into that.
Well, I think what it is like, really where it started is like, I'll go back a little ways. In the commodities market, they used to, they used to look at the weather and, if there's a drought, prices of the commodities went up pretty dramatically. As soon as it rained, all of a sudden they all came down and they're like, well, why are we hedging on the commodity market? Why don't we just hedge what we're really hedging, which is the weather? It's just a derivative of that. Another example of that was even the election, which we did. Like it moved predictable symbols, predictable sectors, and so people were able to say, hey, I don't need to hedge my portfolio, I just need to hedge the election, or even the Fed rate decision, or gasoline prices, or whatever it is if you're into, you have a basket of energy names. So I think what it's allowing people to do is just be more precise with their investment. And I'll give you an example of where this is going to go. Take Apple. I'm a person who studies Apple. There are a lot of people who really love Apple. They get the number of phones right, they get the revenue right, they get everything right. And their thesis is not rewarded because suddenly there's guidance that says something and boom, the stock goes down. And that's very frustrating for them. So they want to abstract that and say, why don't I just have a contract that says all the variables that I nailed are going to reward me for my research. And I think that's going to be beneficial. Very beneficial. So you can imagine where this goes.
All right, Steve. Really fascinating conversation. Got to get you back soon. Steve Quirk is Chief Brokerage Officer over at Robinhood Markets. We did have some breaking news across the wire just a little while ago. This is involving Columbia University and the fight by the White House to potentially push back on some of the policies and practices that these universities has. The latest news that we're getting right now is that the Education Secretary, Linda McMahon, has now said that Columbia University no longer appears to meet accreditation standards. To find out a little bit more about what this means, let's bring in Akayla Gardner, who's down there in our D.C. bureau. And Akayla, I'm a little confused. Are they pulling the accreditation for Columbia, or are they just threatening?
So the Education Department doesn't actually have the power to pull the accreditation, but they are asking the entity that has approved Columbia's accreditation to reconsidering it, say that they have violated civil rights obligations that they have as a university. And essentially what we have seen here is this is a new strategy that the administration hasn't pursued yet. We've seen them revoke funding. We've seen them use other levers to pressure schools. But with Columbia University, what's so interesting about this is the secretary has said, as well as the president, that conversations are moving in a positive direction, especially compared to Harvard University. So this seems to suggest that those conversations maybe are not turning out the way that Columbia certainly wants them to, hoping to reach a closed-door negotiations and a deal with the White House, I should say, to get their funding back.
Akayla Gardner in Washington with that breaking news on Columbia University. The Education Secretary taking a closer look at the accreditation of that university. We turn back to the markets right now as we count you down to the close and take a closer look at shares of Apple. Needham actually souring on Apple today. Remember, it had a buy or a strong buy rating going all the way back to at least 2016. But today, that recommendation now drops to a hold. Increasing AI competition, tepid growth trends among the reasons for that downgrade. The analyst Laura Martin says for this stock to work, it must have the catalyst of an iPhone replacement cycle, which we do not foresee in the next 12 months. Laura Martin joins us right now of Needham to talk a little bit more about this. And I was taking a look, Laura, at just the revenue growth for Apple over the last few quarters. 5%, single-digit percentages, not awful for a company of its size and maturity. But then you look at Meta and Microsoft and some of the other big tech names there. This company is lagging in a big way. And I'm wondering if this is just about iPhone refresh, or is it about something deeper?
Yeah, I mean, good question. I think our downgrade today is really there's urgent problems with Apple and there's important problems with Apple. The urgent problem is, as to your point, it's 26 times next year's earnings, which is twice its historical multiple and a 25% premium to the S&P 500. But also another problem is there's real fundamental risks to this earnings stream. That's the consensus projection. And that is China iPhone demand. There's a negative Epic Games court case out there that would threaten 30% payouts that Apple demands on every app on its platform. And we've now got 5 fines coming out of the EU in multi-billion dollars for privacy regulations and monopoly impact. So lots of things are threatening, not to even mention tariffs, which is today's news. But there's just lots of things working real time against the fundamental outlook here. And then more importantly, competition is coming. Meta has already sold 1 million Ray-Ban glasses as an alternate computing platform, which is code for replacing the smartphone. Google has now entered that business. And we have Johnny Ive, who designed every single hardware product that Apple currently sells, just did a deal to sell his company to Sam Altman over at OpenAI, and they're going to try to create a hardware device based on generative AI, which Apple is taking a pass at, which really does threaten displacing Apple's hardware system, I think.
Right, absolutely. That was a head turner to see that OpenAI deal with Johnny Ive. A lot of anticipation over what that partnership will bear and what fruit it might bring. But let's talk a little bit more about the upgrade cycle, because a conversation I was having with Mandeep Singh of Bloomberg Intelligence earlier today was that Apple is seen as being behind in AI. And it feels like these are two related conversations, that the AI features that they do have aren't enough to entice consumers to go ahead and upgrade their phones.
Agree 100%. And that's why the stock has slid so much, I think, because a year ago, remember, they were talking about Apple Intelligence, and the market Wall Street loves generative AI because it's going to retool the entire U.S. economy, I think is the consensus view. But Apple not only didn't get it done, all the rumors for Monday's WWDC, which is their big developers conference, say it's going to take a pass. It's not going to announce anything about Apple Intelligence. So that's problematic because it looks like it's just ignoring it.
I'm sorry, Laura. Really? Because that surprises me. So what did they announce? I mean, I guess what are your expectations for WWDC? Because if it's not somehow AI related, I mean, is there anything else out there that consumers and more importantly developers are looking at right now?
Yes, they're like, there's chipsets and there's colors and there's new cameras and there's alignment of where the cameras sit, all kinds of cool new things they've been working on. But generative AI, look, the point is you need an Apple iPhone refresh cycle. So you need enough stuff, including generative AI, but not limited to that, that makes consumers want to go out and tomorrow, like when they announce the 17 in September, they buy it. And nothing we've heard makes it likely that happens, we believe.
All right, Laura, really appreciate your time today. Definitely a call that turned a lot of heads. That is Laura Martin. She is Senior Entertainment and Internet Analyst over at Needham and Company. And Romaine, it's
chipsets? I don't want to hear about chipsets.
Chipsets? Come on, what's that?
I mean, I know this is for developers. I know they probably care, but
yeah,
I don't know.
Not me, though.
Yeah, not me. It's all about me.
I do want to point out that fewer than 60% of the analysts tracked by Bloomberg recommend buying Apple right now. You compare that to their large cap cohorts. That's very, very few.
Yeah.
Yeah. So Apple, the shine currently coming off the rose. We'll continue to track that. But coming up next, we'll be speaking to Tobin Marcus. He is head of U.S. policy and politics over at Wolfe Research. That conversation about the latest with trade war negotiations, including President Trump's take on China's Xi Jinping. That's up next. This is The Close on Bloomberg.
3:30 p.m. in a beautiful New York City on this day. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. And we're all focused on what Friday brings when it comes to the payrolls print. But ADP this morning, I know you were in because you were on surveillance.
I was in.
What a miss.
What a miss. And it's funny, most people poo-poo ADP. They say it's not really predictive.
Never trade on ADP.
But when you have that big of a disparity between what the expectations were coming in and what we got, 37,000 jobs. And more importantly, I thought it was kind of interesting to see the complexion of where those jobs were not being created, I should say.
Right.
And this idea that there might be a bit of stagnation going on out there that maybe we're just not seeing just yet.
I'm actually scrolling furiously to find it, but Peter Bukvar was out with a note right after the results, and he showed that small businesses, they actually shed workers on a net basis.
Yes.
Less than 50 workers, those businesses lost 13,000 jobs.
Well, I'm glad you pointed out, because the majority of the softness that we saw were in businesses, smaller businesses, basically those with 19 or fewer employees. That's not a good thing, because remember, they are the bulk of our employers. I mean, we tend to think that it's the Walmarts and everything else, but they only represent, like 25% of the total employment base out there. Of course, the president weighed in on it almost immediately. He saw the ADP number and he was like, oh my gosh, we got to cut rates. Taking to Truth Social, saying Jay Powell, the Fed chair, Powell must now lower the rate. And when he puts it in caps, he's serious. Lower the rate. And he also referenced the ECB cutting rates. We should point out the ECB has cut 7 times, not 9. But it's interesting that he would make that connection between what's going on in Europe and what's not going on here in the U.S. Of course, the economic stories are a lot different than what's going on there and what's going on here.
Absolutely. Yeah. Well, let's keep this conversation going and discuss with Tobin Marcus. He is head of U.S. policy and politics research over at Wolfe Research. And I was just looking it up, Tobin. So I believe Jerome Powell's chairmanship doesn't end until May 2026. We know that the president has backed away from talk of firing Jerome Powell, but certainly that doesn't apply to taking shots at him on social media.
Yes, certainly not. I think there's nothing that has happened or is going to happen that's going to restrain the president from making his voice heard. Separate from him backing off the threat to fire Powell, we did also have the brief Supreme Court decision that alluded to a separate standard that they will have for the Fed if ever asked to opine on whether or not the Fed chair is fireable. So I think we're in relatively stable position on that, but certainly the noise will continue.
Certainly the noise will continue. That seems to be the narrative across a lot of different issues right now, including when it comes to that tax bill. It's interesting to see former Doge head Elon Musk come out really critical about this bill, I believe tweeting in the last hour or so as well, encouraging people basically to call their senators, call your congressmen, and get this bill killed. Tobin, I wonder, you think about the heft of Elon Musk and the influence that he had in this last election. Even though he's not formally involved in this process, do you think that this is going to play a role?
If he really puts his shoulder to the wheel, I think it is possible that he could make a difference here. I don't think just tweeting about it is going to be enough. Compared to the last time that he really tanks a bill in December of 2024, when he brought down the continuing resolution, at that time, he was very closely allied with President Trump, which is no longer as much the case. And he was fresh off having spent a ton of money in 2024 and holding out the prospect of spending money in the future. Whereas now he sort of declared that he's done spending money on politics. If that changes and he really makes it look to these guys like they run the risk of an extravagantly funded primary challenge that he's backing if they continue supporting the bill, I think that will start to get tougher, but ultimately, I think this is still essentially too big to fail. They will pass it because they have to pass it.
Yeah.
The cost of failure for the Republican coalition is just too high.
Yeah, and we should point out, at least publicly, a lot of the Republicans have already turned on Elon Musk, kind of spinning the narrative that he was never really part of the club, if you will. I am curious, too, when we talk about this idea of what is working its way through Congress, there's, of course, still the trade side of this equation, trade and tariffs. Obviously, that's being effectively litigated straight out of the White House. But I am curious as to whether there is a little bit more unification on what Trump is doing, or at least trying to do on tariffs, trying to strike trade deals that, at least for right now, still appear to be elusive.
Yeah, the litigation uncertainty, I think, is going to create a little bit of uncertainty in the trade deal landscape. I think it certainly is not going to stop the process of talks. There's very much a threat that's still outstanding to our trading partners, and so they have to continue talking. But I do think that there's going to be a desire to kind of take a pause and figure out what's going on in some of those cases. Similarly, his ongoing moves to escalate in certain elements of the tariff landscape, I think, complicate those deals. If we're holding out the, sort of reserving the right to raise the sectoral tariffs from 25 to 50% on steel, in addition to the prospective sectoral tariffs that we're still expecting on semis and pharma and various other things, it does make it that much harder for other countries to agree to anything. Of course, reportedly, these letters have gone out. I guess the White House press secretary confirmed that they've sent out these sort of ultimatum letters to various different countries saying to make your best offer, and then we'll come back and figure out what we want to do.
Yeah.
So and if they go through with that, that could bring resolution sooner rather than later.
Yeah, and technically they were supposed to do that by Wednesday, which is today, Tobin. I haven't actually seen any headlines on that yet, but of course we'll bring them to our viewers as soon as we get them. It gets to the point, though, as Washington gets done, and we know Washington likes to sort of, take their holidays in the summertime. If they do sort of get this bill done by, let's just say, the end of June, beginning of July here, are we sort of going to end up in this void with Washington where whatever's left unresolved is basically going to be unresolved until September and everyone comes back in the fall?
From a legislative perspective, this bill is really the one train leaving the station on major fiscal priorities. It will be the vehicle for the entire Republican fiscal agenda. Whatever's in it will get done. Whatever's not in it won't get done. Then they will have the August recess. But even beyond leaving town for a month, the only things remaining to happen are, I think there are some bipartisan areas, for example, on crypto that we could see action. But from a fiscal perspective, they need to keep the lights on. They need to fund the government into FY26. So there will presumably be some kind of stopgap bill in September. But there's not going to be a lot of big, kind of substantive legislation. This really is the one bite at the apple, which is why there's been so much focus on what's in and what's out.
Yeah, absolutely. The stakes are high and the clock is ticking there. I do want to go back to the trade picture right now, and specifically the relationship with China, because before the ADP post on Truth Social at about 2:17 a.m. Washington time, President Trump also posted on Truth Social about President Xi, saying that he likes President Xi of China, always have, always will, but he is very tough and extremely hard to make a deal with. We know that the Trump administration has been pushing for both leaders of both countries to talk directly to one another there, Tobin, but we know that the Chinese delegation doesn't want to do that they would prefer not to have the two leaders actually talk directly to one another. And when you think about the chips as they lie right now, it just seems like we're in a stalemate here.
Yeah, I think a stalemate is a fair characterization of where we are. It's better to have a stalemate at 30% than at 145% tariff rates. But ultimately, there are a lot of unresolved issues between the two countries. And the reason why we're seeing tensions reemerge is because none of these problems was ever solved outside of the tariff space. You know, the Chinese were incensed that we are continuing to crack down on Chinese semis. We've also seen moves to crack down on aerospace, on natural gas liquids, on Chinese students' ability to study in the U.S. And those are all outgrowths of the fact that, across the administration, across Washington, for the most part, China is seen as an adversary, a strategic rival that you kind of need to do things to assert our interests. And so as long as those tensions exist, and they're certainly not going anywhere, it's going to be challenging to truly de-escalate the situation on trade or anything else.
All right, Tobin, always appreciate it. Tobin Marcus, head of U.S. policy and politics at Wolfe Research, as we count you down to the closing bell. Fractional gains for the S&P and the NASDAQ, the Dow and the Russell unchanged on the day. A look at some of the individual movers, and there are some big ones, including Applied Digital. It's our stock of the hour, and it's up next. This is Bloomberg. All right, let's take a look at our stock of the hour, and it is Applied Digital. The share is rallying about 30% after the AI-enabled digital infrastructure platform, building on that multi-day move on the back of a deal with CoreWeave, jumping to the highest level in 3 years. Options volume also hitting a record as investors buy in, with one analyst expecting around 15% upside for the stock. Those shares, we should point out, a 29% gain. That's the best day for these shares since Monday. Jess Menton joining us right now to talk a little bit more about this. This is a phenomenal rally, and I joke, the shares rallied 40-something% on Monday.
That's right.
They took a little bit of a breather today. Now they're kind of up again. What's going on? I mean, this deal was announced, or we found out about it a few days ago.
Well, now you're seeing more sell-side analysts begin to jump in and boost those target prices. So Needham is one of them, talking about how this would really help as far as bringing in more cash. And also, this is a crucial moment because this company is also trying to transition to more of a data center real estate investment trust. So part of this deal with CoreWeave is supposed to be a big part of that transition because that's a longer term type goal, and there's two different periods within this, and so that's really supposed to really help kind of the longer term story for a company like this.
Yeah, it's interesting to see, as you point out. I mean, this is gain, but it looks pale compared to what we saw on Monday. CoreWeave, I also want to point out, co-founded by a Haverford College graduate.
Oh, wow.
There we go.
You talk about how the company wants to reposition itself, be known as a data center REIT, and it feels like that's the move in this market. Those are the types of companies that investors are rewarding right now.
It has, and especially not even just more recently, but in the last year. I mean, from the spring of last year through the fall, I mean, you would see the utility sector taking off, but a lot of that, usually you'd think of that more of a defensive type play, but it was more geared toward those data center type businesses. It wasn't like it was sort of the water type tied sub-industry group to utilities that was taking off. And even utilities year to date, I mean, the best performing sector is industrials behind that, staples, but then you have utilities behind that too. But still, nonetheless, a lot of that is sort of that optimism for those data center businesses, but also the IPO front. If you think about CoreWeave too, even since it IPO'd in March, when it came to that pricing, some of it came in a little bit below expectations, but priced around 62. Actually, where it's trading now, I think it's above $162. So actually, it's like a 300% move there in the IPO front. So when you're thinking kind of more of the public markets as well, so more optimistic.
Well, this is what I'm curious. This is kind of the evolution of that AI trade too. And I see some of the peers. I was trying to find some of the peers for Applied Digital. They also seem to be moved. Some of them are moving on this, Rackspace and a few others. But is this kind of the next evolution of it? So we get beyond chipsets, and into something else?
Well, part of it too is when you think about some of these newer cloud computing type services and how expensive it is to rent some of this out. For CoreWeave, looking at a company like Applied Digital, that's something that's cheaper for them because obviously they're backed by NVIDIA and they want a license. And also when you're thinking about trying to seek some of those chips that are backed by NVIDIA to software developers, this ends up being a play for them as well because that's cheaper. So people are looking ahead to your point, other parts of that AI story, and this is a big part of that.
All right, Jess Menton.
That's a good point,
Yeah, definitely. And great roundup on Applied Digital shares going parabolic. That is Jess Menton with the latest. And Romaine, I think it's really interesting that you talk about this data center push. And of course, that's what's hot in the stock market right now. It's sort of just turned how we typically think of utilities on its head. Typically, utilities have been seen as kind of a defensive play, but not necessarily in this market.
They've been on fire, no pun intended, and not just to go to the traditional utilities. We talk about all the nuclear power stocks that, I didn't even know about, a few years ago, and now, of course, they're the hottest thing out there.
Yeah, the new shiny objects. Now, coming up, we'll take you to the closing bell with Steve Sosnick, Chief Strategist over at Interactive Brokers. That's next. This is The Close.
10 minutes until the closing bell. Romaine Bostick alongside Katie Greifeld with stocks fading just a little bit here into the close.
A little bit, but the color is still green, and that's important. You can see the S&P 500 up.
Am I supposed to be impressed by 0.07%?
I'm going to round up and say that's a whole 1/10%, Romaine. We are below 6,000 and getting farther away. You take a look at the Russell 2000, already flipping into red, down about 0.2%. That had been your big winner for the past month, fading a little bit. But you know what's winning?
What's that?
It's the bond bulls. The 10-year Treasury yield down by about 9 basis points here. We had an offering of weak economic data this morning from ADP, kicking us off at 8:15, and you can see that's translating into a bid in the bond market.
And then that ISM services data, which was, I think, also came as a bit of a surprise to some folks. And there were a lot of components in that. I think something like 10 of the components were still higher, but you had 8 components and really key components like in retail and in construction and transportation and a couple other things, warehousing, that were effectively going down towards contraction territory.
Absolutely. You add it all together, and you could build a case for getting a little bit concerned here. And it seems like that's what's percolating, at least in the bond market, maybe the stock market, a little bit more sanguine. All
right. Well, you're seeing Bitcoin down a little bit here on the day. The dollar back on the weak foot once again here, though the VIX still subdued back below 18. Steve Sosnick joins us right now, Chief Strategist at Interactive Brokers here in Studio 2. And let's start off with the bond market, because that seems to be where more of the activity is, at least today. You saw those moves, 9 basis points on the benchmark 10-year, pretty much across the board. We're getting 8 to 10 basis points lower. And it seems like anytime we have major economic news, major trade developments, we see much more volatility and much more of a price reaction in treasuries than we do in equities.
Well, Romaine, I think there's less of the buy the dip mentality in the bond market or sell the rally mentality in bonds than there is in stocks. I think, when I look at the way stocks are trading, it's almost mechanical at this point. If there's a dip, it's got to be bought. If there's a rally, it's got to be chased. Bonds don't necessarily react that way. Bond traders, I guess, are just more focused on, am I going to get paid back or not, or fewer stories to focus on. So today, where you have a roughly parallel shift in the yield curve, that's telling us it's all about economic numbers. The ADP number was surprisingly bad. It's a very imperfect indicator of the jobs number on Friday, but not good. There was no way to spin that as good. And the ISM numbers, I mean, part of it was the prices paid ticked up a lot, but they're not really too focused on that. But so as long as the curves are as long as the moves in the curve, I should say, relatively parallel, that's okay for stocks. We can deal with that. I think if you start to see meaningfully steeper yield curve, particularly in the back end, it's just telling us that foreigners or other investors don't want to buy our biggest export, which is our debt, that would tend to be a problem for stocks.
This gets to the idea, too, about maybe, and I don't want to call it completely divergence here, but maybe somewhat the disconnect between equities and in bonds. You talk about bond investors, of course, are more worried about just basically making sure they get their money back. For equity investors, it's still about the bottom line in corporate America. That bottom line held up pretty well in the last quarter. I'm not sure how it's going to hold up in the next quarter, but at least some of the guidance the companies gave, or at least the commentary they gave, it certainly wasn't a case for alarm, or maybe it was for you. You tell me.
I'm going to give you a yes, but. I think it wasn't a case for alarm, but we're back at levels where we're back around flirting with 6,000 here. Last time we were at 6,000 on S&P, market was expecting, call it 12-13% earnings growth for 2025. Now we're talking 6, 7, maybe 8. So right now that's the fundamentals telling us that they're not as good as they were before, but the stock market not caring. The other thing is we've become momentum junkies. We all have. Every stock trader that I speak to is pure momentum. Here's the problem with momentum. If you're just strictly using prices and trends to guide your trading, which, by the way, does work an awful lot of the time, but at some point, if you take it to extremes, you're just saying, I don't care about the fundamentals. It's going up, so I'm going to keep buying it. And I see a lot of stocks out there where that behavior is going on. It's not purely, we've kind of, I'm not going to say we're completely divorced from fundamentals, but people are willing to divorce themselves from fundamentals when it's convenient.
Let's talk about a trend that you highlight in the notes you send over to our producers, and that is the fact that you have these pesky foreigners, as you call them, selling overnight. And it is a pattern that I've noticed over the past week, especially that futures tend to fall in the after-hour session, and then you come in and they tend to get bid up over the U.S. day in the cash session. And I wonder what you make of that.
What I make of that is this is the momentum at work, because I put together a little rubric. It's out there on Twitter. It's out there on LinkedIn if you want to find it. Basically, it's facetious, but only to a point. And it was, let the foreigners sell overnight, because I do think money is flowing in general out of U.S. stocks. And then you see sort of around, depends when people wake up, but call it between 6 and 7 a.m., you start to see the futures tick up. And I joke that, people, I think hitting the buy button before they get their coffee or brush their teeth or take a shower or whatever it is they do in the morning. I think first is so you see the futures start to tick up. They sort of move up until about 8:30. Then you could get, today you had a bad piece of news at 8:15 because it's a little off. And then, that was a buying opportunity. And then we kind of churned along until 10 o'clock. Another piece of bad news. Down we went. Up we go again, because that's another buying opportunity. And then, today we're not seeing a lot, at least as far as I can tell, not a lot of buy on the close imbalances, because otherwise you get that sort of rally through the afternoon and then the 350 jump.
Yes, yeah.
Right.
And so, it's a little too easy. When the pattern is that obvious, it lends it, everybody gets sucked into the pattern, and something happens to break it. And I can't tell you what that is. I think it's bond related.
Right. A quick check on the S&P 500 right now, because you mentioned it. We are fading a little bit. The color's still green, but we'll see if that holds for 4 more minutes.
0.02.
Steve, zooming out from the hour-to-hour movement, I want to talk about how you think the rest of this year goes, because in the last few days we've seen a few price target upgrades when it comes to the S&P 500. Deutsche Bank among them, Barclays, and I believe Goldman as well. But we're talking about very small gains, in their view at least. Basically, that the rest of this year is going to be pretty tepid in terms of the actual total return, maybe with some volatility thrown in. What's your view? What do you think the trajectory looks like through the end of 2025?
I think the trajectory is going to be a lot more rocky than we've gotten used to, which is hard to say considering we had 20% up and down and up. But I do think, I think now we've sort of settled into a bit of complacency, VIX below 18. Yeah. I think that we're still looking at a lot of volatility. We don't know how the budget bill is going to come out. We have a grand total of 1 trade deal worked out. I'm not going to get into the politics of chickening out, whatever else. But bottom line is, all these things keep getting kicked down the road, but that leads to volatility. And at some point, the market has kind of started to ignore it, which is why you start to see volatility dampened. But I just think there's just too many moving parts going on between the global economy, the de-globalization, what's going on necessarily in China, in China as well. There's too many moving parts for me to just be completely sanguine and say we're going to keep going in a straight line. Yeah. So I think we're going to get some backing and filling.
All right, Steve Sosnick, Chief Strategist over at Interactive Brokers, helping us count you down to the close. We should point out, at least on a global basis, you did see some strength overseas in Asia, and actually that helped to lift emerging market assets as a group here. But back here in the S&P, we are in the green, but only 0.02%.
And a lot can change in the next 2 minutes or so, so we'll have to see. Below
a full
6,000.
breakdown of all of today's market action starts with our global simulcast right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to the closing bell with a global simulcast. We're joined right now by David Gura and Emily Grafeo in the radio booth, filling in today for Carol Masser and Tim Stenovic, who are on assignment. Alex Steele and Scarlett Fu also on. Is everyone on assignment today?
Everyone
anyway,
but us.
Katie and I, David and Emily, are here to break down all of today's market action here. A really interesting day, guys. Fractional gains on the S&P here, but big moves in the bond market.
Yeah, absolutely. And obviously the economic story is so crucial today when we look at the data that we got from ADP and from ISM. I'm also just focused on what we got from the Congressional Budget Office today, indications that the House passed big, beautiful bill, to use the president's term, would add $2.4 trillion to the deficit. Just interested, guys, how that's going to kind of color the job that the Senate has right now as it tries to piece together its version of that legislation with the president's goal here of getting that bill on his desk by July the 4th, one I think we can call a wildly ambitious goal, but we see the Senate kind of working at it now, and I wonder the effect that's going to have on them as they kind of haggle over it and hash it all out.
Yeah, David, I mean, you mentioned the weaker economic data. It was interesting that for a lot of the trading day, the S&P 500 was able to climb higher, even though it showed that economic data was weaker. But into the close now, you're starting to see the trade reflect that.
Well, it's funny. It feels like the bond market and the stock market have been talking past each other for a while right now. And Romaine, that certainly was the story for the bulk of this trading session today.
Absolutely. So we should point out there are some pretty big gainers, particularly when it comes to the semiconductor space. But you are seeing weakness in other parts of tech, including Tesla and CrowdStrike, Dollar Tree among one of the biggest decliners here on the day. You've added up all together here, and you basically got a market, let's just say it, guys, really going nowhere on the day. The Dow Jones Industrial Average giving up about 80 points or about 0.2% as we wait for these numbers to settle. The S&P 500 right now straddling the line between gains and losses, 59.70.84 on your screen. But once again, that number could adjust just a bit. If it stays where it is, that is basically unchanged on the day. The NASDAQ Composite up about 62 points or 0.3%. Similar gains for the NASDAQ 100. And to the downside, transports, mid-caps, and the Russell 2000. The Russell 2000 down 0.2%.
Robin, as you say that, I'm looking to see sort of how much green there is on the screen, how much red there is on the screen. 241 of the S&P 500, 244, higher than they were at the beginning of the day. 257 of those stocks down, one unchanged. So a real mix in keeping with what you've been describing here, the way that the market is kind of muddled through today.
Yeah, and let's put that in sector terms as well and take a look at this circle right here. You can see there's a lot of green. You have information technology, certainly a big proportion of that. What did the best on the day actually was communication services. You can see that green is a little bit brighter than the others. And then you have some sectors you don't necessarily always see leading also in the green. Materials and real estate. Real estate obviously makes sense with that big bond move. On the downside, you do have energy off by about almost 2% as a total sector. Utilities also in the red in a big way, off by about 1.7%, David.
Let me take you through some of the gainers that I've been looking at today, starting with BKNG Booking Holdings. I love a Delaware-based holding company here. This owns Booking.com, Priceline.com, Kayak, and the rest. Obviously, we're focused on the way the travel companies are dealing with the economic uncertainty and the kind of contours of the trade war. JP Morgan maintaining it with an overweight, raising the price target there from 53.60 to 6,000. So one that I've been following this afternoon.
All right, one other mover here on the day is Five Below. They dropped about 0.8% in the regular cash session. The share is moving even lower now in the after-hours trade after its earnings just crossed the wire. The company said the first quarter EPS did come in at about 75 cents a share. That is a beat, so that is certainly good. But here's your guidance going forward. For the second quarter, the company says it expects a range on EPS of 45 cents to 57 cents a share. The street on average was looking for 58 cents. So the high end of that range is below the average of street estimates. As for sales and revenue here, comp sales, let me just go back to the full year here. They are providing a full year sales figure, net sales 4.33 to 4.42 billion. That actually, believe it, is actually above its previous guidance that it had given of 4.2 to 4.33. So you add it up all together, you had a beat in the quarter, but the guidance going forward seems to suggest some weakness on the bottom line, though they do seem to be guiding a little bit higher on the top line.
A lot of interest in those trendy fund and affordable finds at Five Below, it seems. Let me turn to another stock I've been watching today, but also over the course of the year. That's Netflix. We saw UBS raise its price target on Netflix to $14.50. UBS citing secular trends and competitive dynamics remaining supportive of Netflix's ability to drive stronger monetization and operating leverage. And just to give a little bit more color here, Netflix up 40%, nearly 40% this year. And I'll stick with companies based on the West Coast. Do Meta as my last gainer here. Saw a price target hike from JP Morgan a day after a company announced a partnership with Constellation Energy. Talked a lot about that yesterday, but that 20-year deal that it brokered for nuclear power going forward, and I think kind of encapsulates this company's interest, doubled down interest here in using AI and using AI for advertising in particular.
Okay, let's get to some of the decliners. CrowdStrike dropping over 5% today. This is a cybersecurity company that projected revenue for the current period that trailed estimates. They see sales for the second quarter will be as much as $1.15 billion, just slightly missing estimates of $1.16 billion. This, of course, was the first financial update since the company announced it would cut about 5% of its global workforce. Later in the trading day, we also got a headline out of this company that they said the DOJ and the SEC sent inquiries on firm accounting. The firm, though, said that they are cooperating with the inquiry, but that stock, again, down over 5% today. Dollar Tree was another company with a warning out today. They warned investors that their second quarter profit could be down as much as 50% from a year ago as it deals with tariff-related costs. Dollar Tree, not to be confused with Dollar General. Dollar General generates about 80% of sales from food and consumable goods, which are less reliant on imports. Dollar Tree gets almost half of its revenue from those categories. It's more reliant on goods from other countries, so they are more exposed to that hit.
I do want to get to some other earnings. We just got through Five Below. Let's turn our attention to MongoDB coming out with their results. They boosted their full year adjusted EPS forecast. They also beat estimates. Their first quarter adjusted EPS came in at $1.06. The estimate had been for just 67 cents, so quite a beat there. You take a look at their full year adjusted EPS. They see it between $2.94 to $3.12. Previously, they had seen $2.44 to $2.62. So quite a big beat there. And you're certainly seeing that in the after-hour movement in the shares, up about 9% at the moment there.
Yeah, this was a much needed bid for MongoDB. This stock was down 14% year to date through today's close. So we'll see how those gains translate into tomorrow's trading session. But just back on the decliners, my last one is not a stock. It's an ETF. Uh-oh. Katie's going to like this.
Go off.
I did this for us. XLE. This is an energy stock ETF. Energy was the worst performing sector in the S&P 500 today. We saw stocks across that sector retreating along with crude oil prices after Saudi Arabia is now pushing for more supersized output hikes from the OPEC Plus group of producing countries. Marathon Petroleum, Valero were some of those names that were dropping. And of course, that ETF down, closing the day almost down 2%.
All right, we have to talk, of course, about what we saw in yields because we came into today. Yields were higher, but only fractionally. It looked like we weren't really going to get any real movement in yields, and that changed in a big way right around 8:15 a.m. New York time on the back of that ADP report, and the decline accelerated once we got to 10 a.m. And that ISM services report. We basically went from yields higher to yields lower, down about 8 to 9 basis points between the 2 and your 10-year. And of course, you see that 30-year yield dropping about 10 basis points, a big revision. We should also point out in forecasts in the swap market for what the Fed may do next, pricing in the possibility of at least about 3 cuts this year, potentially, and now potentially more certainty for a cut by September. I do want to turn our attention to another story that was really just burning up the Bloomberg terminal. Have you been following this ship that's just out, apparently just drifting out there in the Pacific Ocean? It's full of electric vehicles. Apparently, it caught on fire. And of course, the crew realized, when you have a fire like that with those lithium batteries, you get the heck out of there. A big incident out there. We don't know exactly which cars are on there, do we? But this seems to be a repeat of what we saw. Remember, a while ago, I think that was, it was a couple years ago, when you had all those ships coming over from Europe, those cars coming over from Europe that sunk.
I will just say it's important to note that the U.S. Coast Guard did evacuate all 22 crew members, so now we're allowed to make a little bit of fun of this story. There were 800 EVs on this ship, 3,000 cars in total, and a large proportion of them, you guys, were EVs. So there you go.
There's a metaphor here somewhere, but I was struck as I read that piece and had to kind of imagine this ship bobbing about on flames, this conflagration in the open seas. That EV fires can take up to 8,000 gallons of water to cool. So yes, folks are gone. We can laugh at the circumstances itself here, but really an indication that this is a difficult thing that these shipping companies are having to deal with going forward. Yeah, and that other big one, of course, that was off the Dutch coast with those back in 2022. Of course, we were all wrapped by that incident as well. All right, guys, that does it for us. We'll let you get back to it there in the radio studio as we wrap up our cross-platform coverage on Bloomberg Television, Radio, and YouTube. And a reminder that Bloomberg Business Week is now on Bloomberg Originals. All 4 of us, or I think some combination of us, will be back same time tomorrow, same place. Thanks for watching. And our coverage does continue here on Bloomberg Television as earnings wrap up. We're going to try to get a better read on the consumer, and we're going to get that from a legend in the retail space, Mickey Drexler, joining us in just a second, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All All right, welcome back to The Close. When you take a look at equity markets, particularly the top line of your screen, that really does tell the story. Not a whole lot of price action going on in stocks on this day, but you did see a lot of price action going on in other parts of the market. A big drop in the dollar and a big drop in yields on this day, largely because of that economic data that we got out this morning. A jobs report from ADP, maybe potentially a prelude to what we get in official government data on Friday, and ISM services data that did show some degree of contraction in that space. Remember, services, the biggest part of our economy. Bitcoin also selling off just a tad on the day, as there was a little bit of risk-off sentiment. You take a look here at some of the individual movers on the day. Fannie Mae taking a big leg down about 9%. Remember, it fell double digits yesterday. A lot of concerns right now about the potential to finally release that company from its conservatorship. That might not actually be as fruitful for investors as they would have hoped. The idea that the government may maintain some control. Meanwhile, Wells Fargo, which had actually rallied hard earlier in the day, only closed fractionally down. But a big story there, of course, with the Federal Reserve lifting its asset cap on the company, giving it a chance to grow. Two other interesting stories out there. Guidewire, the biggest gainer in the Russell 1000 here on this day, on the back of its earnings, a beat and raise earnings period. And to the downside, the biggest decliner in the Russell 1000 was Dollar Tree, down about 8%. A company not just only grappling with the potential for a slowdown in consumer spending, but more importantly, still grappling with those tariffs and the uncertainty around it. And that brings us to our top story of the hour, the state of retail and the apparel industry. Earnings season for that group is largely winding down, as this season was of even greater interest for investors amid concern about consumer discretionary spending and the impact of tariffs on the bottom line. Now, we're still waiting to hear from PVH a little bit later. That's the company that operates Calvin Klein and the Tommy Hilfiger brands. But we've already heard from all the others, the Abercrombies, the Gaps, American Eagles, Ralph Lauren, VF Corp. And it was a mixed bag overall, with some brands showing resiliency and others, well, struggling for relevancy. So what separates a winning apparel brand from the rest, especially at a time when consumers are becoming a bit more selective? Well, who better to pose that question to than retail royalty? Mickey Drexler. His creative direction helped to make the Gap and J. Crew the epitome of cool, taking fashion basics and making them feel anything but basic. And he's still going strong. He's now the chairman of Alex Mill. And he recently collaborated with the boutique retailer Henry Lehrer. Pleased to say Mickey's joins us here in the studio.
Thank you very much.
Looking sharp as always.
Well,
when you look at the state of retail right now and apparel, there were a lot of great stories. I mean, we've had some comeback stories for the Gap, for Abercrombie, and a few others. But we're also at a period now where people are concerned about consumer spending, whether they have the money or not. People are concerned about tariffs and how that's going to impact sourcing materials. How, as an apparel maker, do you even navigate in an environment like this?
Well, this is a tough environment, plagued with unpredictability. How do you deal with running a business longer term when you're not sure short term what the cost of goods will be? And right now, a lot of people are raising their prices because they have to cover the costs, and others probably aren't, but very selectively. For us, for example, we look at every style to see what should go up, what might stay, but I've never experienced what's going on today. And I think, I don't know from consumer confidence reports, but when you read about the news, you watch the news, and it's real news. And even the budget thing, I don't know much about that stuff. Yeah. But it's all scary.
Well, let's take tariffs for a second, because we know so much of our apparel right now, to some degree or another, is sourced from other overseas, whether it's the fabrics or in some cases the entire product.
Absolutely.
And it's not just buying from China. I know that's kind of the narrative, but it's, you might get something from China, then it goes to somewhere in Southeast Asia for stitching, and may go to Mexico for something else for finishing, and then come back to the U.S. for the final touches here. So how does that disrupt the process when you don't know what you're going to be paying on those goods, whether it's going to be a 10% increase or a 50% increase?
Well, it's disruptive by definition. We're looking at prices, say, from China, 37.5% more. And, we're not passing. We're a small player in a big world.
Right.
But, it's just difficult to fly blind. And a lot of us are flying blind right now. I speak to a lot of my friends. Well, anyone. It's not just in the apparel world, toy world. You look at and America cannot manufacture clothes. for a number of reasons. They don't do it. You know, the factories in the world are mostly, China's our factory headquarters for everyone.
Hold that thought, because I'm curious about that. And I just want to point out to our viewers, we are getting results out of PVH. This is the maker of Tommy Hilfiger and Calvin Klein. We should point out on the bottom line, they did beat in the most recent quarter, $2.30. Revenue came in above estimates. But of course, the guidance is what's causing problem. The guidance for adjusted EPS for the current quarter, that's going to be lower. The revenue on the revenue side, that's going to be lower. Why? This is the headline. They says the tariff mitigation actions have not really taken effect just yet, and that the tariff impact will be negative, a tariff impact, in their words, of about $1.05 a share. And you see the reaction in the shares. And I am curious about this idea, Mickey, of what mitigation there is, because you say we're not making anything here. Is it that we don't have the expertise to do it, or is it just too costly to do it? What's holding us back from reshoring things as the way the president wants?
You know, we've had a world economy and a world sourcing, and all of a sudden, in America, you know, it's not that we can't do it. We just haven't done it. And how would you get geared up to become a manufacturer in America? There's a few out there, and we're looking at the very few, but we're not geared to run a company long term with buying. We do all our jeans in America. We do whatever we can do. But you don't get geared up for this. You go to where the best makers are. You go to where the best sewers are, the detail, fabrics. That's the business we're all in. Good products. But I don't know of any business, I'm not an expert on this, where something or other's not made in China.
How much pricing power do these apparel makers have right now, if at all?
Well, when you say the wholesalers, or
I'm talking more. Well, let's start with the wholesalers. I mean, how much can they pass those prices on?
To there's buyer? My personal opinion, wholesalers usually inflate prices to their customers, retailers, department stores, because they build in the sale. If you look at what's going on today, the integrity of pricing in America, everything's on sale. Or if you look at TV ads, and 40 off this, 50 off that. And people know that when you give 50%, even the networks, NBC, they have shows in the morning, everything's 40 off.
So does that mean they can absorb some of those costs? Because it's funny you point that out. I'm not going to say which company, but I was looking at a particular clothing item. And I noticed some shenanigans on the pricing on the website. I went, they had a sale, and then I went back a few days later, and it was a different sale, but the price didn't match up with what they had previously. It was very confusing.
You go online with a lot of companies. You pay less than you do in the shop. That's, if you look at it, again, the integrity of pricing. I learned as an early merchant at Bloomingdale's, you sell the goods at the same price wherever you buy it.
I want to get your thoughts on the retail model. You mentioned Bloomingdale's. There's been a lot of talk about department stores, or really just multi-line retailers all over. And I mentioned in the intro, you're collaborating with Henry Laird, and obviously this is a much smaller scale store. But is there still a role for the multi-brand, multi-line, consumer-facing retailer?
Well, I have a lot. I'm actually speaking. We sell the multi-brands, our brand. I moved out of multi-brand when I learned that if I couldn't own my products, I can't control the market. And I learned that at Bloomingdale's, because Alexander's, an old discounter, would be carrying the same goods as we might on sale. And I didn't know anything but to meet, I was a buyer in a big corporation. I didn't know anything but to meet the prices. And I think that goes on all the time now. High-low, it's called.
But what can they do to fix it? I mean, and the other day I was walking home and I walked past the old Barney's building, which is near the Bloomberg headquarters, which is still vacant. And it was kind of a reminder of kind of what the golden age of department stores used to be. And I know Bloomingdale's is still going strong, and to a certain extent Nordstrom is finding its footing as well. Do you see, though, that it will just have to be maybe one or two big players like that, and that's the only space that will allow?
My friends accuse me of saying that for 20 years. It's very hard today, if you don't control your products, to protect yourself against a discounter. I always say to people, when you're ready to buy something, before you give the credit card, go online and check the price of that. There's always something out there that you're buying that someone's running a sale on. So what does that do long term to the reputation? Look, when I was a young guy, there were like 30 department stores around. Now the big ones are the dominant ones. We do business with most of them, so I hope they don't get mad at me for saying what I'm saying. But you know, when I went to Apple, Steve Jobs wanted to do. He didn't want to depend upon the big department stores, the discounters in his case.
Yeah, and there were a lot of people that derided that decision when they first made that announcement. They were moving into retail. They were saying this doesn't work. And of course, now it's become the centerpiece of who they are.
People deride most good ideas.
Yeah.
You have an idea.
But you were involved in that. And you had a way of sort of looking at what the retail experience is going to be. Now, they got it right. At the same time, it has to evolve. When you look at, I don't know if you've been in an Apple store lately, but has it evolved enough?
Well, it's evolved, but Steve, we lost a great person. The stores are pretty much the same way. I worked with him on the design. They're simple. The products speak. So I think the stores are great, and it's a great company. But look at the problems they're going to have. Steve was one of a kind.
Yeah.
I mean, who knows what he would have done had he lived longer.
Yeah. So, and it's kind of interesting, too. We were talking about the other day of Johnny Ive, who's now partnered with
Johnny and Steve, lunch every day.
He's with Sam Altman now, and apparently they're working on some AI device. I don't know if you're involved in that at all.
No,
but I think about just his design aesthetic that he brought to the computers and eventually to the iPhones and iPads. And that was something that I know is difficult to replicate. And in fairness, and I'm not just trying to gas you up, you kind of fall in that category as well when it comes to dealing with the clothing basics and providing a certain aesthetic that was hip and cool, that was hard to replicate because it was all just up here, wasn't it?
It's all up. You can gas me up anytime, by the way. But Johnny and Steve, and you can't do this without a right team. Every day they had lunch in Cupertino. Johnny was, you're right, he did it. I don't think you can learn what they did in school. People say, how do I get to be this, that, and the other thing? There's a DNA, in my opinion, that people have. It's kind of a gift. I interview people with DNA in mind on creativity. You're not born with well, you are born with certain skills, as you know. But, it's... They were a duo like no other.
All right, Mickey, always a pleasure talking to you. Always appreciate you coming in. Mickey Drexler, of course, now chairman of Alex Mill. All right, we do want to take a look, go back to those earnings that we got out of PVH. Those shares moving lower here. The company's saying that adjusted EPS for the full year will be in a range of $10.75 to $11 a share. That's below the previous guidance it had given of $12.40 to $12.75. Mary Ross Gilbert joins us right now to break this down for us. And I guess this wasn't a surprise, Mary, but give me some idea here of what they're saying as to why they had to lower their guidance.
Yeah, so Romaine, it's kind of like you said, it's really the tariffs. They expect a $65 million hit, so that's like $1.05, but that's unmitigated, and we expect them to be able to mitigate some of that higher cost, and it will happen in the second half. That's what they talked about. They also talked about in the quarter, they saw some headwinds in Asia Pacific. We knew that was going to be off due to the timing of the Lunar New Year. So we expected the double-digit climb that came in there. But as you pointed out, they beat. They beat on the top line, they beat on the bottom line. And most importantly, when we're looking at the guidance, they reaffirmed guidance to be flat to up on a constant currency basis. And when you look at everything that PVH is doing in terms of their Tommy Hilfiger and Calvin Klein brands, we just got this new collab with Formula One. So what they're doing is they have a new APX GP collection, and this is in concert with the Formula One, the movie, and that stars Damson Idris, and he is one of Tommy Hilfiger's.
Well, that should be good. I'm excited to actually see that movie, and I didn't realize that there was that tie-in there with the PVH and Hilfiger. It gets to this idea though too, and I just want to ask you just specifically on the tariff front too, because PVH did say that their tariff mitigation strategies are largely going to be in the second half of 2025. Do you have any idea of exactly what that means? What are those strategies?
Yeah, well, just when you look at all the other apparel companies and what they're doing, they're negotiating with their suppliers. So the suppliers are absorbing some of it. They're also focusing on, hey, where can they save money? It also includes selectively raising prices. So it's not across the board. It will be on items that they feel are, more inelastic. So that's really how they're going to go about it. So I think when I look at the news, I don't think of it as really being all bad. We expected to get a hit from tariffs. I mean, every single company is being affected.
So kind of wrap this up, Mary, and I don't mean just with PVH, but overall, I mean, we're basically through the apparel retail earnings season. I know we still have Lululemon coming on Thursday here, but was this overall in line with your expectations?
Yeah, I would say in line to better in many cases. There were only a couple of companies really that had a miss or were disappointing. And usually it was due to some execution issues. But other than that, I would say across the board, it was kind of as expected to maybe even better in some cases.
All right, Mary, always appreciate you taking time. Mary Ross Gilbert over at Bloomberg Intelligence. A closer look at the breakdown of retail earnings, specifically with PVH just crossing the wire. Those shares are moving lower on the day. And just a reminder, we also are going to get Lululemon earnings on Thursday after the bell as well. So a closer look there at a different side of the retail landscape. When we come back, we're going to talk politics. We're going to talk policy. Daniel Tannebaum, partner over at Oliver Wyman and a senior fellow with the Atlantic Council, is going to share his thoughts on President Trump's call with Vladimir Putin and what it could mean about imposing new sanctions on Russia. You're watching The Close on Bloomberg. All right, President Donald Trump spoke to Russia's Vladimir Putin in a phone call earlier today, according to Trump. Putin warning the president that he would retaliate for the Ukrainian drone strike on Russian airfields over the weekend. Now, this all comes as more than 80 senators have signed a bipartisan bill to impose new sanctions on Russia, testing Trump's appetite to punish Putin. Joining us right now is Daniel Tannebaum. He's a partner at Oliver Wyman and a senior fellow with the Atlantic Council. And of course, you specialize in sanctions, so perfect person to talk to. I want to start off first with this phone call that we heard about earlier today. Obviously, we don't know all the contours of the detail. Other than that, Putin apparently, I don't know if he's going to strike Ukraine in retaliation, but it did seem like that was part of the conversation.
And that he doesn't want peace. So President Trump has actually cleared a lane somewhat for the Republicans to put this, what should be big, beautiful bill on the floor of sanctions on Russia that they've been reluctant to move on for fear of what the president's reaction would be thus far.
So does this give them cover then to move that forward?
I think it does, because the whole point of these sanctions, and actually the language even in the bill, is if it seems that Russia is not willing to negotiate, then the president should impose X sanctions, and it lays out kind of what he should do. This gives him cover of, well, he doesn't seem like he wants to negotiate. Businesses are not exactly clamoring to get back into Russia. Now, there has to be some thoughtfulness here because it imposes a 500% tariff on any goods coming from countries that continue to buy things from Russia. Which includes Europe and India and China.
About to say, I was like,
so there's carve-outs that are being contemplated. But I think this does give the president some air cover.
I mean, we mentioned all of the Republican support for this. Is this going to be a veto-proof bill, though?
Right now, 82 senators have signed on to this bill, which is a veto-proof majority. Speaker Johnson in the New York Post yesterday was quoted saying he's supportive of sanctions, so signaling that the House could move on this as well. So you're really seeing a big push, especially off the back of Senators Graham and Blumenthal's visit to Kyiv this past weekend, coming back saying we have to put more pressure on Russia.
I am curious about how much pressure can be applied. And maybe you could kind of walk us through, because I've kind of lost track of saying, when I hear like new sanctions on Russia, I think, okay, well, like what more is left to actually sanction?
Oil. There's still oil and gas purchases.
But they made it clear they don't, in the past, that they really did not want to do that because there would be dire economic consequences, not for Russia, but for the folks buying it.
The last administration was hell-bent on ensuring no adverse impact on the energy markets. This administration, as we've seen, may not be as fond of looking for unintended consequences, which could play to the advantage of further punishing Russia. So there are more revenue that can be attacked on energy. There's still raw materials in the form of uranium and other minerals that are purchased from Russia, so continuing to deprive them of that capital, there is more that can be done there. There's also countries that are supporting them militarily in Ukraine, like North Korea, which have supplies from other countries like China. So there's other countries you can begin to put pressure on to try and further isolate Russia.
Has Russia's hand gotten weaker in all of this? Because, I mean, coming into this presidency, U.S. administration, the general consensus was that Putin would have the upper hand given his relationship with Trump, however you want to interpret that.
The defense sector is keeping the Russian economy afloat. So this war is essentially funding what is perceived as the growth of the Russian economy at this point. It's hard to say who has a weaker hand. Certainly the Ukrainians, between destruction of the bridge in Crimea and their successful drone attack almost 3,000 miles into Russia this weekend, certainly showed that they still have some cards left to play. But he is still weakening the longer this goes on. The Russians are losing more revenue with every passing month in the energy space.
But then at the same time, and amidst all this, there is the reports that the U.S. would not provide air cover support for Ukraine should there be some sort of peace agreement, which seemed like basically saying, look, you're going to be on your own one way or the other. It's
pretty unclear where this administration really stands on Ukraine. On Russia, anytime there's a negative thing said about the Russian government, there's a both sides thing talked about Zelensky and the Ukrainians. This administration has continued to provide some degree of support, but it's certainly been limited. They actually have done some things in terms of increasing pressure on Russia in March, allowing an energy trading waiver to expire that essentially banned certain oil trades with Russian banks. The president also extended a Biden-era Russia sanctions package in April to to no fanfare.
I am curious, in about 10 or 11 days, the G7 leaders, at least, are supposed to meet in Alberta, I believe, in Alberta, Canada. I assume this is going to be a big topic of conversation. Do you think that there's any chance there will be any sort of consensus?
I think it's becoming clear, especially as you see the Republicans in the House and Senate begin to speak out a lot more publicly on their views, that the president realizes he has the air cover to actually pick a side, and that side might not be Vladimir Putin. I think we are seeing movements in that direction. There really wasn't much publicly said, certainly not by Speaker Johnson, and very few senators were speaking out beyond Senator Graham. The support is there to punish Russia. Now, this Congress has said it won't do anything without the executive branch. There is a precedent where in 2017 they did pass sanctions and made them veto-proof. I think it was 98-2 in that instance in the Senate. So there is a chance that the Senate could move without the president's blessing. I'm not sure if that'll actually happen, though.
Yeah, and I mean, they got to first deal with this budget bill, and then I think after that they all just want to go on their 2-month summer holiday. Final question, and this is just a little bit of a pivot away from just what's going on with Russia, and it's really just about the whole tariff strategy overall that Trump has deployed. And I know we've got so many deadlines coming up, but I do wonder, particularly with some of the clients you deal with, how they're navigating that. And I know this doesn't sort of fall into the category of sanctions, but it does fall into the category of how you do business in a global economy where you have no idea if the rules are going to be different tomorrow versus today.
Look, you had Mickey just on talking about this. I got a note from my girls' camp that the slides that they were supposed to get for the showers are not showing up because of supply chain issues. I mean, my daughters tried to buy bathing suits and saw massive tariffs on the e-commerce portals. This is having a real impact on American consumers. And that uncertainty makes it impossible for companies to pivot accordingly because they don't know where that policy could go next.
All right, Dan, we've got to leave it there. Always love talking to you. Daniel Tannebaum is a partner at Oliver Wyman and senior fellow with the Atlantic Council. All right, we want to stay on the topic of trade because the U.S. Trade Representative Jamieson Greer is now saying that talks with the European Union are advancing quickly. Now, the EU's commissioner told Bloomberg Surveillance earlier today that retaliatory tariffs could be on the table without a mutually beneficial agreement. Here's what he had to say.
From European Union side, we are willing to find a mutually acceptable solution with United States as regards the tariffs, also to put an end to this uncertainty and to avoid further also global economic fragmentation. If we are not able to find mutually acceptable solution, we are ready also to put those counter tariffs in place.
Vladis Dombrovskis talking a little bit earlier today, and we should point out that alcohol distributors are also caught in the crosshairs, with China using a brand levy to bring France to the table. For more on how tariffs are impacting the world of alcohol, let's bring in Marvina Robinson. She's the founder and CEO of the champagne brand Stuyvesant. She imports her champagne directly from the Champagne region of France, as the name implies. Great to see you again, Marvina. I hope to one day talk to you under much better circumstances, but I think the last time we spoke was right around Liberation Day, when we were starting to see these tariffs at least be announced. And I know to some degree a lot has changed, to some degree nothing has really changed. And I am curious as to, are you still anticipating that you're going to have to basically pay more to get your goods into the United States?
Well, post our last time speaking, I did pay my first tariff bill about like 2.5 weeks ago. I have not passed that fees on to my consumers. Being that there's still discussions, I don't want to have yo-yo with my prices. And it is a little roller coaster trying to decide what the prices are going to be, because the tariffs change daily, in my opinion, right? 1 minute it's, okay, this is going to be the price. This is the threat. When we started with the 200%, then on Liberation Day we got 20%. Then we got, we're going to pause it for 3 months. Now we're at 10%. But if conversations don't go right, there's always a threat of where the tariffs can go. So me as a small business owner who business is really based in Europe, it's hard to really plan, especially for quarters, what's going to happen with as far as inventory. I try to keep my inventory high because I did pay my tariffs to get shipments over here just in case things change. But I normally don't move as much inventory as fast.
Now with champagne, I would think, I mean, just correct me if I'm wrong, but you can kind of keep that in inventory on ice, as long as you, for a long period of time,
you have to properly chill it.
It doesn't necessarily expire, right? It's not necessarily perishable.
No, about 4 or 5 years. If you're in a good warehouse, no, it's not direct sunlight. So we have that. But for me, my business is based on fresh disgorgements, which we used to do quarterly. Now with the tariffs, I'm in the process of moving inventory up faster, just in case something happens, and I don't want to get stuck in the crossfire.
How are you able to move things forward? I mean, because obviously this is still dependent on just the normal agricultural cycle of when things are harvested, and obviously the whole process to make champagne takes some time. So is there an opening, like when you see, okay, tariffs are on pause, can you sort of hit a button and say, okay, give me everything I need right now?
So when we first got introduced with tariffs, and this even started from last year, I always have inventory semi-prepped and ready to go, right? Because it's also transportation. You have to get a boat slot and schedule. So when we first started conversations, I started to do a disgorgement so that when it's time, when it's ready, when we get a break, okay, let's move the inventory. When there was a threat of the 200%, everything was put on pause, because once it's on the water and it imports into the States, I would get hit with the tariff if it was at 200%. Obviously, I'm not going to pay that. So when we got the notification of 20%, I said, okay, we have shipments, pallets ready, let's move this.
Sorry, just to be clear, so when we talk about the tariffs that you have to pay on the U.S. side, that's based on when it hits the U.S. port or when it leaves the port over in Europe?
Once it hits in the U.S., we'll get the notification.
So you can basically have your ship in the middle of the ocean and then find out that you're going to pay more for that shipment than what you thought. What are shipping costs themselves like right now? Have they been affected by all of this?
The shipping prices are kind of semi-standard for me. I haven't seen a jump in that. But what happens is as we get more congestion, like towards the end of the year when it's peak time for champagne imports, prices do go up. I have not seen any price differences yet, so I'm really glad about that. The only major difference I have right now is the tariffs.
I am curious about the consumer side of this. There's been a lot of talk about whether consumers are pulling back, and particularly on discretionary goods. And let's face it, for champagne is a discretionary, for most people, discretionary good. I'm sure some people,
not for me. No.
Some people it's a staple. But it gets to this idea: are you seeing any pullback that people just maybe are saying, I'm just not going to buy the bottle of champagne, or I'm going to buy a cheaper bottle somewhere else?
There has been a mixed feedback. A lot of my customers have sent in emails like, we're still here, we're supportive. I've been gracious enough to actually break into the Texas state industry. So I'm happy about that. We got picked up with a new hotel, a new private club. I think it all becomes down to each person's individual. Even myself, like I'm a shopper of champagne as well. And you know, I look to see what prices have changed, where I know what prices are, to see if any have changed. I have witnessed prices have increased on other brands. But for myself, you know, like I also, you know, I take heed as anybody else.
I am curious, do you think consumers will notice? If you just bump the price up a little bit. And the reason why I ask is I feel like there are certain products out there that as consumers, we know exactly what they cost every day. And so I know if I go into the store and it's $1 more, I'm going to notice it. I have to say, I buy a lot of wine. I might not actually notice if that, $50 bottle of wine is now $53 or something like that. And, I'm not trying to be sneaky, but is there a way that you can pass the cost on to consumers in a more incremental way where it's not going to really shock them?
Well, I've sent out notifications to all of our clients and customers that with the pending tariffs, you might see an increase coming in the near future. We haven't done it as yet, but when I do, I want to be crystal clear. There will, I will send out notification. And if we did have to do a price increase, I'm going to try to keep it as low as possible. Like you said, a $3, $4, $5. I'm not going to just go to like
But
10,
you want
15.
to be transparent about it. You want to say.
I will be transparent about it.
And
yes.
you're not worried. I mean, I don't want to get political, but you're not worried about backlash. We've seen, of course, the president go after bigger retailers who have basically said our prices are going up, and it's specifically because of the tariffs.
I'm not worried about it because I want to be fair to my customers, and I want them to know why we're doing so, and that's the reason why.
Do you think, and I hate to look at a worst case scenario, but do you think there could be a point if this tariff situation isn't sorted out that you would just have to stop importing altogether? No. I will be. Part of this also is based in the U.S. I also decided that I need to break into other markets in case these tariffs do become a serious problem so that I can still keep my business running. All right, Marvina. Well, I appreciate you coming by to check in with us, and we'd like to check on you again some point in the future. Yes. Wish you the best of luck. Marvina Robinson there. She is the owner of B. Stuyvesant Champagne. All right, let's take a look at how markets closed here on the day. Fractional gains, and I use the word gains very loosely here. The S&P 500 just barely poking into the green. You did see the NASDAQ Composite and NASDAQ 100 higher by about 0.3%. The rest of the equity space was in the red, including those cyclicals, which had big outperformance yesterday. But the big action was in the bond market and it was in the dollar. The dollar back on the back foot with the BBDXY back down to 12.09 and your 10-year yield dropping almost 10 basis points to 4.355. 5.2 and change. This is the close on Bloomberg. All right, welcome back. Taking a closer look at markets and taking a closer look at animal spirits that may just be alive and well in the IPO market. The stablecoin issuer Circle now has an impending debut and is now expected to price above the market range. We're on watch for that right now. It could cross the wire at any minute right now. Let's bring Katie Roof into the conversation, who's out in our West Coast bureau. And Katie, this is, I'm taking a look, $27 to $28 per share. That is the range that they were marketing at least according to Bloomberg sources. Any additional information, any idea if they're going to hit that?
Sure. So according to Bloomberg reports, it's going to price either at the top or above the range, which usually indicates strong demand. So, it's a good sign for Circle. And it's also part of a pattern we've seen recently with, the recent tech IPOs pricing at or above the top of the range.
Absolutely. We talk about eToro going public was a couple weeks ago. A couple others I'm sure I'm forgetting. This is also a big test of appetite just for the crypto space overall. And I can't remember. You can kind of remind me. I can't remember the last big crypto-related IPO that we had. This is a pure play here. And I am curious, given all the bounce up that we've seen in Bitcoin and some of the other major tokens, as well as just the general attitude right now in Washington towards the crypto industry, there's a possibility this could be successful, right?
Yeah, and so, eToro, as you mentioned, crypto is part of what they were doing, but, you're right, this is purely crypto. It's different than Coinbase, which was one of the bigger IPOs, or really they did a direct listing in recent years. Rather than being a crypto exchange of all sorts, Circle is more focused on stablecoins. They are largely connected to USDC, which is a stablecoin that moves in tandem with the US dollar.
When we talk about this idea of what the appetite would be for this, and I know there are a lot of people that have looked at this idea of the stable coin and kind of said, well, why would I need to buy, as an investor, buy into Circle? What's going to be the uptake for their stable coin, particularly given that, there isn't a big moat around this. You have Tether, which is already out there. There's been a lot of talk that at some point in the future, you might even see big tech companies, big retailers even move into the stable coin space as well.
Sure. I think the key is that a lot of people like to diversify their investments. And so I think that, the Circle or crypto in general is just one way to do that. I mean, certainly we've seen, different types of crypto investments. Some have, ridden a wave and then crashed and then come back up. So it can be more volatile. But supposedly the stablecoin appeal is that it could be more stable.
Yeah. And speaking of that demand, I was just kind of taking a look at the reporting, and I guess based on what we learned out of the filings here, ARK Investment, of course, the empire run by Cathie Wood, planning to buy, or interested, I should say, in buying about $150 million of the shares from the IPO, and BlackRock, which of course has a big reason to buy this, 10% of the IPO shares, according to people familiar with the situation. That's not insignificant, and if BlackRock says they need 10%, that must mean they're seeing demand on the other end of that side, on the end of that equation.
Yeah, I'm sure they have good visibility into what demand looks like. I think this is part of a broader trend, not just with crypto, but tech in general. For a while, there weren't a lot of tech IPOs, but the few that have gone in the last year or so have actually mostly done well. And so I think what large institutional investors are looking at is that, they're buying at the IPO and they're seeing that those tech IPOs are making them money. And so for now, it looks like the window is open for tech IPOs.
So what's the appetite then? When we talk about this idea, and we knew that all these companies were it was kind of that pent up demand, basically coming off that weakness that we saw out of last year. So when we talk about the runway of what's out there, Katie, is there still a lot more that is going to potentially come out of this fire hose at some point? Or have we kind of gotten the gist of what's already out there?
So we have Chime, which is coming up. That's a fintech neobank. But, actually, other than there's Discord and Figma that are considering going later this year, but there actually aren't that many venture-backed IPOs likely for this year. A lot of them are still very spooked about the tech correction of 2022. But the reality is we have 1,000 unicorns. It's 1,000 private companies that have yet to go public, and they have to do something to provide some sort of returns for their investors. So we may see a lot more at a later date.
All right, and we should point out to our viewers, they have just updated their S1 filing here. That's just crossing the wire here on the Edgar database here. Not enough time to really parse through it here, but of course, we will break that news right here on Bloomberg as soon as we get it. Katie Roof out there in our West Coast Bureau as we await potentially the newest IPO, and that would be the stablecoin issuer, Circle. That is going to be one of the things to watch for overnight and into tomorrow. We're going to also fill you in on some of the other things to keep an eye on when we come back after the break. This is Bloomberg. All right, let's push ahead to the next 24 hours, some of the potential market moving events to keep an eye on, and that includes earnings. Before the market, one more read on the consumer, and this time in the restaurant space with Cracker Barrel set to report earnings before the bell. Now, after the bell, we do get a continued read on the consumer, but this time on the retail front. I want you to pay attention closely to Lululemon because that, of course, has some outsized effects when it comes to discretionary spending and, of course, when it comes to tariffs. We're also going to get earnings out of Petco, and we're also going to get earnings from the tech space as well. Broadcom is set to report here. Remember, this is also a chip story. It's also an AI story, and it's going to be an interesting setup, of course, heading into Apple's big worldwide developers conference on Monday. Meanwhile, on the economic and trade front, we should point out that the ECB is scheduled to make a rate decision 8:15 a.m. Eastern time. They have cut rates 7 times this rate cutting cycle. Be interesting to see what happens from Christine Lagarde in the morning. Meanwhile, we'll also get a read on the U.S. trade balance. And of course, we know where that's been going. It will be a big focus on imports and whether those imports have continued to decline. 8:30 a.m. Eastern, team surveillance will be all over that. And tomorrow, the start of the NBA Finals. Unfortunately, the New York Knicks won't be in it, but it'll be an interesting matchup between 2 mid-market teams. All that and more coming up a little bit later right here on Bloomberg. Stick around. Balance of Power is up next.